request all members to rise for ICAI motto song prayer.
Yaesha sukteshu jagrati, Yaesha sukteshu jagrati, Kamam 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 kamamsho, pursho, nirmimanaha, nirmimanaha, Tadeva shukram, Tadeva shukradabramha, tadabramha, Tadevamritamucchate, Tasmin lokaha, tasmin lokaha, shataha, Sarve tadunatyati kaśchan, etadvaita, 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 etadvaita.
Those members who could not find seats, we have an adjacent room where this is getting telecasted, so members need not stand and they can be seated and have a complete view of what's happening. The budget 2018, a lot of push for the agri sector and the health sector, a mixed response evoked from corporate taxations, and they said the focus were more on small and medium sector businesses. The standard deduction of 40,000 introduced by withdrawing few. The analysis have already started telling that in fact the government is taking more by adding it together if they take the cess into consideration of 1% which has been hiked. The cryptocurrencies, government has said big no, but however they have adopted the technology. They said the blockchain technology, which is the very basis of cryptocurrencies, that will be adopted for the other things which will be handled by the government. So today we have with us C.R. Bhupati, past president of ICAI, who is there to share with us the amendments which is there for the budget 2018, and also welcome our indirect tax expert Sri Vaitishwaran sir. I request him to come and join the dais. Welcome, sir. My request C.A. Falguna Kumar sir to formally introduce our first session speaker, C.R. Bhupati.
Om Namo Venkatesa. Esteemed speakers of the day, Sri C.R. Bhupati, Sri K. Vaidishwaran Advocate, senior members, our SIRC Secretary Ungarsan Jain, colleague Gopalakrishna Rasu, ladies and gentlemen. So we have been eagerly awaiting this 2018 budget. So there are many macroeconomy aspects which the government, to bring the financial discipline, has taken into account. We are only looking at the direct tax and indirect tax proposal as it is the tradition in this Brahmaya Hall for the past 30 years. But the macroeconomy, how they are trying to consolidate, is really a wonderful thing. Anyhow, we will have time, but I will discharge my duty as a privilege to introduce our erudite speaker, Sri C.R. Bhupati. As we all know him, but anyhow briefly in 2-3 lines. He has seen more than 40 budgets as a practicing CA and presented more than 70 times on the budget live discussions. So today also he has readily accepted on behalf of the SIRC on the very first day itself to address the issues that are placed in the finance bill. He served as the resource person in all the professional institutes, and as a member of the Central Council for 9 years he served, occupying the highest position of the President of the ICAI for 2003-04. Thus, as an illustrious President, left the tread path for the growth of the profession. He is also a member of the Education Committee of the International Federation of Accountants, IFAC, an apex body of the accountants for the worldwide for the period 2003-06. He served as the chairman of the International Fiscal Association Indian branch, the Southern region also for 2006-8 period. He is a director and chairman of the audit committee of the few listed companies in India. He is the recipient of the award, recognition for the service to the society, sharing of the knowledge, the two prestigious awards, that is the Paramacharya Award and then a certification award given by the Confederation of Asian Pacific Accountants. So, none other than Sri Bhupati alone is the fittest person here today to speak about the direct taxes and their intricacies. Though it is the bill stage, we hope, we wish that a majority of the provisions are going to become the Finance Act. So, with this brief introduction, I request you to join your hands to invite our erudite speaker, Sri Bhupati sir.
Thank you, sir. I'll introduce other speakers. I may request C.A. Gopalakrishnan Raju to introduce the second speaker.
Advocate K. Vaidiswaran, a cost accountant and a company secretary with 27 years of experience in advisory capacity, as well as through appearance through various appellate tribunals, courts, with respect to all the taxation matters. He is very fondly called among the student fraternity also as Vatiswaran when VAT was introduced. His first comprehensive book was VAT in India. A specialist, considered as a national speaker and a specialist on tax matters, possesses in-depth thorough knowledge on tax matters. He is part of the working group on GST CII Southern Region and currently the chairman of the Expert Committee on Indirect Taxes for Madras Chamber of Commerce and Industry. He is also a member of the Southern Council of the Indo-American Chamber of Commerce, member of the Taxation Committee for FICCI, and also member for Regional Advisory Committee for Service Tax Commissionerate Chennai, a member of the Finance and Taxation Committee for CII Southern Region, and member for Southern Council of Indo-American Chamber of Commerce, and very, very hyperactive in all the social medias, especially on Facebook. Maybe his other side is a very good singer, and whenever rather than referring to Hindu or other newspapers about the film reviews, usually his Facebook will be a guide for us to choose whether we have to see a particular film or not. That's Mr. Vaidiswaran for all of you. Friends, please join your hands for Advocate Vaidiswaran.
Thank you, sir. I now request our past President C.R. Bhupati sir to talk on the direct tax proposals.
The Secretary of Southern India Regional Council of ICAI, Mr. Dugarchand Jain, the immediate past chairman of the SIRC, C.A. Palgun Kumar, Gopalakrishnan Raju, SIRC member, my co-speaker, Vatiswaran, who is going to address us on the indirect taxes provisions. First of all, let me begin by saying a big thank you to the office bearers of SIRC for extending an invitation to me to speak on the proposals of the Union Budget 2018 of our incredible India. It's also a very pleasant moment for me to visit or enter this nostalgic hall. The way it has transformed over a period of years, when I remember only half this room was for classes, half the room was for the SIRC library. Totally not air conditioned. we could hear the noises from Nungambagam High Road than what we speak. From that stage onwards, it has transformed into such a big auditorium, and I'm glad so many meetings are taking place at a regular basis in this hall. It also gives me an opportunity to meet so many of you, so many familiar faces, many of whom I would be able to recollect by name. So, giving a gap of say 2-3 years, not coming for these type of meetings on a regular basis, I am deprived of meeting you at more frequent intervals. But when they said, initially I was reluctant to attend, not the way he put it, so willingly accepted. The reason is, on the day of the budget itself to speak is something I would like to postpone, because it is very difficult to grapple. See, he spoke for 2.5 hours, the finance minister presenting, and we have to absorb the gist of it and share it in a manner understandable to all in a matter of say 45 minutes means it's the most challenging assignments. But the flip side of it, the advantage of it is, if you miss out some points also, we got a reasonable excuse. So, having said all these things, let me take some amount of your time to explain the salient features of the direct taxes proposal, and also bring in forefront the situation under which this budget was presented. That has to be analyzed first before going to the direct taxes proposals. Last budget of this government before the elections. 5th budget, consecutive budget of Mr. Arun Jaitley of this government. First budget after the introduction of GST. First budget where the railway budget and the finance bill are presented together. And we want consolidation. There is a problem of fiscal deficit which the finance minister has to address. This is the overall situation, and if you see, if you have watched the articles in the Business Standard, read it very thoroughly, Business Standard, Financial Express, one key indicator of our country, which was repeatedly pointed out by the economists, is that everything is growing, but employment is not growing at the rate at which we anticipate it to grow. Although we get lots of WhatsApp messages saying that this company wants to recruit, you could apply, but in effect, the productive employment, based on the statistics which agency in Bombay has collected by applying a very sophisticated, acceptable statistical tool, as based on the information which they gather from the Provident Fund offices, they have categorically mentioned that the employment has not grown the rate at which it is expected to grow. This is a matter of concern. The agriculture sector was under stress. So these broad aspects the finance minister has to address, and rightly so. In the major part of his speech, for nearly an hour and 40 minutes, he gave about the various schemes listed out, and also telling the huge amount of allocation which he has given for each sector. He has identified farmers, agriculture sector, and given them the greatest of allocation in this budget. Healthcare is something which is very critical, very important for all of us. With the advancement in medical science, the longevity of the people has gone up. The number of years people live post-retirement is equal to the number of years people live pre-retirement. So we have to accumulate sufficient funds to meet the exigencies post-retirement. If that is the case, healthcare, and then what is lacking in the ease of doing business in our country? We were 69 or 70 then we got promoted, and today we stand in a better pedestal. Ease of doing business, we need infrastructure. So the emphasis for infrastructure. And then, of course, MSME, that is medium, small, and micro enterprises. These aspects, the finance minister has given the right emphasis. There cannot be two opinions on this. Having finished that, ease of doing business, but I was listening to the radio, and our Mr. Chandrababu Naidu of Telangana state, he made an, it is not only ease of doing business, we must also improve the ease of living in India. Ease of living in India. In fact, the Prime Minister also, in his speech after the budget, I think he came on a quip on the TV, and he reacted saying that ease of living in India should be improved. Having mentioned this, now what has he done? The first thing is, contrary to our expectations, and contrary to what is being circulated by means of WhatsApp messages to all of us, people had a very fond expectation that the threshold limit will be increased. People also anticipated that the rate of tax will be reduced in the first slab so that the small taxpayers will get benefited. I've been telling this, Palun Kumar, when he introduced me, he made a mention that I have seen 40 budgets. Out of the first 3 can be excluded because I wouldn't have got the full impact of it. But even then, what is happening is, I've been telling for the past so many years that no government, even in a school and college days, they'll ask, what will you do if you become the finance minister? Write an essay on it. This is a very popular theme they'll give. Now, if I give the opportunity to any one of you to assume charge as the finance minister of our country, would you increase the threshold limit? Is something which you will not do. The reason is, with a lot of difficulty, the government of India has increased the number of people filing income tax returns. If the threshold limit is increased further, that is from 2.5 lakhs to between 3 lakhs or 3.5 lakhs, the number of taxpayers will get reduced. And if the number of taxpayers get reduced, it is not a good thing for a developing country. And therefore, no finance minister, according to me, would increase the threshold limit by a substantial amount. Even if it is done, it will be done by 5,000 or 10,000 rupees. You cannot expect the way people were circulating by 50,000, 1 lakh. That's a dream which will continue to be a dream and never a realized dream. Having finished that part of it, the other thing which is tax rates also have not changed. But for the corporate sector, if the gross receipts do not exceed 250 crores, they have said the tax rate is reduced from 30% to 25%, living up to his promise which we gave in the last budget. Last budget he made a universal thing that he will reduce corporate tax from 30 to 25, but instead of totally avoiding it, he has given it to this extent. Simultaneously, what they were referring to, he increased the cess from 3% to 4% to accommodate, and he called it by a different name. Earlier it was called education cess and higher education cess. Now he says a health and education cess to accommodate the various health programs which he has tried to formulate in his budget. Now coming to the salaried class of people, he gave very interesting statistics that the number of salaried class of people who are filing returns have gone up, and the tax they contribute to the government has also gone up. Therefore, they compared it with the professional and business community. It is not happening the way. Rajendra, can you come here in front? Now, he gave interesting statistics and said he is going to reintroduce the standard deduction. The standard deduction of the salary or 40,000 rupees, whichever is less, he is going to give you as a standard deduction. The greatest advantage of the way the standard deduction is introduced, that it is applicable even to pension income. Even those people who receive pension will be eligible for this standard deduction, which is a good amendment. The second important amendment is regarding to the senior citizens, and for the Mediclaim insurance policies, the premium which is paid was eligible for a deduction under Section 80D of the Income Tax Act up to 30,000 rupees. Now it has been, limit has been raised to 50,000 rupees, which is again a good amendment to take care of the post-retirement expenditure. And the concept of very senior citizens has been done away with. Here afterwards, there will not be a concept of very senior citizens. Citizen and senior citizen, that's all. And senior citizens, medical insurance, so 30 to 50,000 rupees, and medical expenses for specified ailments has been increased. The limit has been increased from 60,000 to a lakh of rupees. These are post-retirement, as Prime Minister said and the Finance Minister also said, that ease of living in India, that's and must live honorably the post-retirement days. Now coming to another thing connected with the senior citizens is that interest on SP account as well as interest on fixed deposits with the banks, cooperative banks and post offices, all put together, if the interest up to 50,000 rupees is exempted from tax under Section 80TTB of the Income Tax Act, a new section which has been introduced. It is applicable only for senior citizens. 50,000 rupees limit. Simultaneously, he has amended the TDS provisions, and 194A of the Income Tax Act has been amended to say TDS up to 50,000, there will not be tax deduction at source on the interest income. While I was reading the budget proposals, I received a call from overseas, and the person there, after listening to the Finance Minister, is asking me a very specific question. Sir, I am a non-resident of India. I have fixed deposits, NRO fixed deposits. Am I eligible for the increased 50,000 rupees interest income exemption? That is something which is close to his heart. He asked me this question. And when you go through this section, it's very clear. It does not make any distinction between a resident or a non-resident. If you are a senior citizen and if the interest income exceeds up to 50,000 rupees, you can claim, both on SP account as well as on fixed deposits. The earlier section which was there was available only on interest on SB account. Today it is available interest on SB account as well as, but the difficulty for non-residents of India is that 195 has not been amended. 195 has not been amended. So if the interest is going to be paid on NRO deposits, tax will be deducted at source at 30%, and the non-residents may have to file the return and get a refund of the TDS part of it. The amendment has been made in 194A, but there is no amendment in Section 195 of the Income Tax Act. Now, having made about the senior citizen, now we'll come to a very touchy area, which the share market reacted. Stock market took a roller coaster ride. Went up first, came down, and then again went up, and again settled down at a particular level. It is the long-term capital gains on listed shares as well as units of equity-oriented funds. Under Section 1038 of the Income Tax Act, the long-term capital gains which are subject to security transaction tax were completely exempted from tax. Completely exempted from tax. But now what they have done is they have introduced a tax of 10% on long-term capital gains arising on sale of listed equity shares or units of equity-oriented funds if the long-term capital gain exceeds 1 lakh of rupees. Up to 1 lakh. Therefore, they are taking care of the small investor. If your long-term capital gain is less than 1 lakh of rupees, even now it continues to be exempted. If the long-term capital gain is more than 1 lakh crore rupees, you have to pay tax at 10%. Please note that this section is coming into force from 1st of April 2018. Thereby meaning, if you are going to transfer the shares, equity shares, listed equity shares, as well as units of equity dividend funds today, before 1st of April 2018, you will continue to get the exemption. You will continue to get the full exemption. Therefore, those of you who want to book the long-term capital gains, then you could still continue to get the exemption under 1038 up to 31st March 2018. Now you will ask me the next question, what happens if I don't sell it before 1st April and I sell it after 1st April? And if you sell it after 1st April, Finance Minister has explained that this terminology is very popular in these days. Therefore, I will not refrain from using it. I will also use the same terminology, in the sense there's a grandfathering of the clause. This grandfathering of the clause, in the sense, if whatever is the value of the equity shares as well as the units of equity oriented funds as on 31st of January 2018, 31st January 2018 will be taken as the cost for the purpose of computing capital gains if you sell the shares subsequent to 31st March. If you sell it on or after 1st April, you could take the fair market value of the shares or the units of the equity oriented funds as on 31st of January 2018, that is yesterday. That means the appreciation up to 31st January 2018 is not subject to tax. Unfortunately, the stock exchange quotation on 31st January was not very high. The previous day it was very high. 30th January it was very high. 31st January it was not high. So that's, to a certain extent, we were not lucky, I would say. Anyhow, that's the provision, and that's why people, it's a very good case. If you ask me as a professional whether this amendment is correct, whether it is in the interest of the country, whether it is absolutely required, my answer is yes. If you ask me as an investor, I will say no. So when self-interest and the country's interest prevails, my country's interest has to prevail over the self-interest, and I would say recommend it. I will also say it's an amendment in the right direction. When it was, exemption was given, when Mr. Chidambaram gave the exemption, at that time the situation was totally different. Stock market was really under stress, was put under tremendous pressure. Therefore, there was a need to give a boost at that point of time, and hence the exemption was given. We have traveled a long distance. And therefore it's the right time to, and that also is not very steep, 10%, and secondly, only it exceeds 1 lakh crore rupees. So these two things, Now, and while computing this long-term capital gain, no benefit of indexation. No benefit of indexation on the sale of shares as well as the units of equity-oriented funds as well as units of business trust. It's here indirectly real estate investment trust and business trust also will get affected in the process. Now, one amendment I did not know whether it has caught the attention of all the professionals, which I would like to focus and change the tone at which I speak, because many times Finance Minister said, Madam, this is an important point. Madam, this is an important point. Here, so I have to say, addressing all of you, this is a very important point. This is dividend distribution tax. Dividend distribution tax, what they have done is, if you see the existing provision under 115(o), for the purpose of dividend distribution tax under that chapter, the term dividends is as defined in section 222, clauses A to D under the existing law. If you go to 222, you will have 5 clauses, clauses A to E. But for this chapter, it was clauses A to D only till now. What they have done is, in 115O, they have made an amendment and they have said that explanation they have omitted. Therefore, all the clauses in 222 will be applicable, the dividend distribution tax will be applicable. Therefore, 222E also, you have to pay dividend distribution tax. Up to now, the shareholder has to pay tax on dividend which are falling under the meaning under 222E. Company need not pay dividend distribution tax. All along people were talking that dividend distribution tax will be abolished and tax on shareholder will be reintroduced. But instead of doing that, they have widened the scope of dividend distribution tax. So it provides, I have to explain to you 222E, although this audience may not like me to go into such details of 222E, but I will give you a framework. If you refer to 222E, it says, a company in which public are not substantially interested makes a payment in the nature of a loan or advance to a shareholder holding not less than 10% of voting power, or to a concern which such shareholder has got substantial interest. That loan or advance will be deemed as dividends in the assessment of the shareholder to the extent of accumulated profits of the company. It's a fairly lengthy sentence, but I have given it without a pause. So having mentioned this, now 222, that dividend also comes under dividend distribution tax. But the most critical part of it is, on dividend distribution under 115O, the rate of dividend distribution tax is 15%. But if it is dividend which falls under 222E, the rate of dividend distribution tax is 30%. If you are traveling from one place to another place, one is a route with too much of traffic, another is a route with less of traffic, we will prefer the route with less traffic. The government has done the same thing. It's easier to catch the company rather than to the shareholder. So it's easier way they are adopted, and they ask the company to pay tax at 30% on the advance which they give to a shareholder, which is deemed as dividends under 222E. This was not spoken in the budget at all. Nowhere a mention was made about this. Nowhere, if you read the main points also, it is not coming. But 115O has been amended, 222E has been touched, and a very significant amendment which will boost the revenue collections. Another very important thing throughout the income tax law which is happening is that the buzzword today is compliance. We have a duty in professional circles to inform all our clients that we have to comply. People who do not comply with the provisions of tax laws, either they have to comply or they have to perish. Now, one small amendment has been made. Earlier, certain sections on which you claim deductions under Chapter 6A pertaining to income, you have to file the return within the time stipulated under 139(1). Only a few sections they have mentioned. But in this budget, what they did was, they took off all those reference to sections and said, if you are claiming any deduction under Chapter 6A, any deduction under Chapter 6A pertaining to income, you have to file the return within the stipulated time. Just imagine if 80 IB of the Income Tax Act, 100% of the profits you are eligible for deduction, and if you don't file the return within time, 100% of the profits will be chargeable to tax. A punishment which is really very severe. So we have to pull up our socks and start working from 1st April onwards. Tell our people internally, this is the last date. You cannot afford to delay. If you afford to delay, if your income is 100 crores, 30% of that, and together with interest for non-payment of advance tax, just imagine, you will not sleep for the rest of your life. So this is a problem on compliance, very important. Long time back in the Bombay Chartered Accountant Journal, I read an article, and the person argued out very nicely in that article 50C is a very draconian section. If you are going to sell a property which is less than the stamp duty guideline value, then for the purpose of computing capital gains on the sale of the property, 50C empowers the income tax department to substitute the stamp duty guideline value for the sale consideration and compute the capital gains. But let me ask Dugarjan Jain, he is having a mobile in his hand. Who is not having? Everybody is having. Now, if I ask him, what is the value of this mobile on such a small instrument gadget like this, what value will you tell? I know it should be very expensive. How much value? 20,000. If you ask Vaidiswaran for the same mobile, will he say 20,000 or 21,000 or 22,000 or 18,000? No two people could agree on value. If it is such a small gadget like this, there could be two values or as many number of values as the number of people in this hall. For a building, can two people agree on a value? Or an immovable property, two people can agree on a value. Therefore, rightly, in 50C as well as section 56 of the Income Tax Act, they have given a bandwidth. A bandwidth, if the consideration in the document and the stamp duty guideline value, if the difference is going to be less than 5%, there is a bandwidth given. If the difference is going to be less than 5%, then the power which is given to the officer to substitute the stamp duty guideline value is not there. Fair enough. It is given both for 50C computation of capital gains, and if the property is undervalued and less than the stamp duty guideline value, it is treated as a gift also, and it will be treated as income. For that also, this bandwidth is made available. Another very silent amendment according to me, if you sell a long-term asset and invest the net consideration in bonds, you are eligible for exemption under 54 EC of the Income Tax Act, and you have to make the investment within 6 months. Very silent amendment has been made. Under the existing law, the lock-in period is 3 years. For 3 years you should not, now they have extended the lock-in period to 5 years. Therefore, if you are in respect of assets transferred after 1st April, the increased lock-in period will be applicable. Very small amendment, but very significant amendment, because your funds will get locked up for a lower rate of return for a longer period. Hope my sentence falls in place. Lower rate of return for a longer period, 3 to 5 years. Now, another very significant thing which has happened, we fought the case because many interesting developments took place in our administration of tax laws through the medium of ICDS, Income Computation Disclosure Standards. And you are all aware, the court struck it down, saying that you cannot amend the law through a notification of a standard. And many of these standards became ineffective because of these court pronouncements. Now they introduced 145A of the income tax, 145B, sorry, 145B of the Income Tax Act, which says that giving effect to what was our objection? You have not amended the law. They amended the law now. They amended the law, and whatever is the implication under ICDS, which was made ineffective because of court judgments, have now been formalized by means of an amendment in the Finance Bill 2018. Most important of it is the percentage of completion method for computing income for contractors. It is already there. But ICDS extended the percentage of completion method to service providers to contractors. Whereas the courts have held that this percentage of completion method should not be made applicable to service providers of contractors. They have said that way. Now, what they have done in 145B is they have extended the percentage of completion method even to service providers to contractors, and now we cannot have any objection because the law has been amended. So many of the amendments sought to be brought through the ICDS have been formalized now. Having finished that, one more significant thing is, you are all aware that the type of assessments which the department is trying to do, no longer hearing you, calling you for information, documentary evidence, they get information. In fact, one of the other reasons why earlier 10 years back talking on the budget was relatively easier, because we used to get the hard copy of the finance bills along with the annexures in advance if you are speaking 1 or 2 days after the meeting. So we will be having all the information at hand, whereas the listeners may not have access to such information. Today everybody is having a load of information. So anything which we say is easily verifiable. At least they could, to the extent of saying that we are wrong, they could tell. See, if that is the case, now what is happening is, there are so many authorities which have to provide information to the income tax department at regular intervals through a prescribed format. The registrar who registers the document has to send, banks have to send, mutual fund depositories have to send. So many agencies have to send information to the department. Based on the information, these people do a selection of assessment and they do the assessment. Now what they have done is, these authorities, when they are required to give that information, they have to give it within time. If they don't give it within time, the existing penalty is 100 rupees per day of default. Now this existing penalty is sought to be increased to 500 rupees per day of default. 100 rupees becoming 500 rupees per day of default. It only reiterates my earlier statement, compliance. If you don't comply, then the compounding effect of interest and penalties, we have to go to IBC, insolvency. So that will be the impact of it. Having finished that, one more thing. Those authorities under the same section 285BA, they said that the authorities, the department can give notice to the authorities to furnish the information. And if the notice says you have to give it within 3 months or 2 months time, and if they don't give it within that 2 months time, 3 months time, then for that the penalty is, existing penalty is 500 rupees per day. It has been increased to 1000 rupees per day. 1000 rupees. Therefore, I'm not trying to, the 1st of February seems to be a good day for many, but I'm not trying to frighten all of you, but I'm only trying to share what is the insights into the budget, so one has to be a little more careful. Now, what has not been said very clearly in this budget, and what we anticipated, is that we need money for all these plans which the finance minister has listed out. Health plans, the infrastructure, so many thousand crores of rupees he has allocated for everything. Where is he going to get the money from? And that is what he has to explain in detail. He has given an explanation, but how far it will materialize is something which we have to ponder upon. One is, because of the effective implementation of the direct taxes after the demonetization, the gross collections from income tax he expects to grow up. That should become a reality. Otherwise, the existing fiscal deficit of 3.3 of GDP will go up further, which is not good for the country. Second, he expects a huge increase in GST collections. This is the second thing. Third, disinvestments he is talking about, but nothing serious has happened excepting one disinvestment of Air India. Other things, when they asked the secretary also, he said it will come, it will take its own time. The only thing which he has suggested is 3 insurance companies will get merged into one insurance company. So these are sort of darker sides of what is prevailing. So one has to be careful. One thing which he did mention, which he has to elaborate further, which I am sure all of us will be thinking in the same direction. Globally, internationally, you will find interest rates in the rest of the world is not even as high as what it is in India. Interest rates in the rest of the globe is much less than what we have in India. Therefore, in all fairness, we should access the funds from outside India for our growth, for our infrastructure, for our health plans. We should be able to mobilize our own people living outside India, non-residents, asking them to invest in India, because they don't get so much of interest income there. Here we could give a little more interest, so that has to be done. During the course of his budget speech, the finance minister did make an observation that he is planning to introduce something known as the hybrid securities. Hybrid securities, what is the plan, what is the action, has not been spelled out. Hybrid securities possibly is a blend of debt and equity. And if they are going to bring, and he has also brought in the International Financial Center, wherein he has given 2 concessions. The book profit tax for it's not at the regular 18%, but it is at 9%. So he has tried to do that, and if he does it in the right spirit, I think more money could be mobilized. So these are some of the amendments, and the last of the amendments which I would like to really touch upon is in the computation of book profits. The computation of book profits, you will find if what we call as the insolvency resolution process is adjudicated by the authorities. Now, while computing book profits, in the definition of book profits, from the net profit as per profit loss account, you have to add a few items, deduct a few items. One of the items under the existing law you could deduct to arrive at the book profits is the loss as per books or the depreciation, whichever is lower. The loss as per books or the depreciation, whichever is lower, can be reduced from the book profits. But what they have said, rightly said, it's a good amendment. If the process under the insolvency resolution process has been admitted by the authorities, then while computing book profits, you could deduct the unabsorbed depreciation and the losses, and losses you could deduct. So this is a very significant amendment. Otherwise, on one side you are asking the company to be declared insolvent and go into the process of liquidation. Other time you ask him to pay book profit tax. It is not falling in place. Hence, it's a good amendment. In fact, this was not highlighted. Finance Minister should have made a mention about this, but he did not mention. But in the question which was asked to the Revenue Secretary, whether in the finer prints this has been added, he said yes, it has been done. So after that, when we read this in 115 JB, they have introduced them. These are some of the significant amendments, and the process of assessment is now going to be more by e-assessments. They are talking about a group of people making an assessments. So entire methodology of completing an assessment is going to undergo a sea change, and one has to equip ourselves not to visit the department, but sit before the computer and see how effectively you could manage it. So it has got both plus and minus points. In person, you could adjust your answer depending upon the reaction of the officer. But in front of the screen, that facility we don't have, unless they come online, video conferencing comes. So that is, till such time, we have. That's why when this option of e-assessment is given, some of us don't prefer the e-assessment. We would like to go in person, make a representation, so that our answers can be slightly modified to meet the requirements of the officer in the interest of our client. Okay. So having explained all these provisions, a substantial part of the amendments in direct taxes laws I have tried to highlight within the limited time which was available to us. Today it was like preparing for examinations, going to the examination hall. We continuously start preparing for the exams, and once the time comes, we pack up everything and come. That's all. Only thing is, in a meeting like this, the results are instantaneous. We need not wait for 60 days. Thank you so much.
Thank you so much, sir, for the crystal clear thoughts. And may I now request Advocate Vaidiswaran sir to handle the indirect tax proposals.
Good evening, friends. Respected Sri Bhupati, my good friend Mr. Dangar, Falgun Kumar, Raju, and other friends. First of all, let me thank the Institute for calling me year on year. And it's now marked in the calendar. In fact, whoever is in charge in SIRC will block me about a month before and say that don't commit on budget, you're there at the SIRC. So I've taken it as granted and always made available. And it's a challenge to read through the whole stuff and try to bring it. Today, I was in some nice mood, so I decided to do a PPT also. Before we understand the intricacies of this budget, on a lighter note, many of us know Major Sundarajan as well as Tengai Srinivasan. They will speak in Tamil as well as English. Mr. Jetli was like that today. There was a threat that the entire budget is going to be in Hindi. In fact, I had planned to quit straight away and wait for the actual text. But then he was nice enough to take care of the southern part of this country and speak in English. Wherever critical, wherever relevant, he did a translation. So it was very well packaged. In fact, I would, if you have to comment on the other aspects of the budget, something phenomenal I've seen in this budget, because they've tried to address some very critical issues like health and education. And they also tried to look at rural infrastructure. Maybe you may call it populist, you may call it 2019 plan or whatever it is, but a very smart budget. It's not, to visualize something like 5 lakh per family for insurance is something phenomenal for the entire country. Now coming to this indirect tax proposals, these numbers are very interesting. The budget estimates, if you look at, from a corporate tax perspective, we are expecting something like 6,21,000 crores. And from a personal income tax perspective, look at the jump. From 4,41,000 crores, they are expecting something like 5,29,000 crores. Probably there is a message in the budget speech where he talks about how the presumptive scheme has failed miserably and how there is a vast difference between individuals offering income tax and salaried employees offering income tax. So you can take the message in the way you want to take. Customs, 1,12,500 crores. Excise, 2,59,000 crores. Of course, this is confined to the 6 products. Service tax obviously has died. we are back to surcharge. After all the tamasha, after all the GST, after slide after slide after slide after seminar after seminar after seminar, all taxes are subsumed. No more surcharge, no more cess, only GST. We are back to surcharge. And that too, please understand, if it is surcharge, it need not be shared. It will go to the center for that particular purpose. Of course, Mr. Bhuvadi sir was talking about where the money is going to come from. Money is going to pour from this to some extent. So, Chapter 6 of the Finance Bill 2018, there is a provision called Section 108 which talks about levy as a duty of custom, and it is to provide and finance education, health and social security. Goods specified in the first schedule, which means all the goods in the Customs Tariff Act, effective tomorrow. It is effective tomorrow. So, your SAP systems, if they are not ready, God bless you. Some of the old softwares are very adequate. They allow multiple categories, layers, because some new tax will come. Some of these new fellows think that once GST has come, nothing else will come, therefore they will just program for GST. You won't be ready for this. At 10% of the aggregate of taxes and cesses levied and collected by the central government under Section 12, very cleverly drafted. 10% of the aggregate duties means, so for example, if there is a BCD, that is a basic customs duty. Now, you have the value and then the BCD, both are added and then IGST is calculated. Now, when they talk about, there is a clear category, they want to protect IGST, they give an exemption. But when they talk about 10% as a surcharge and basic customs duty, given at the overall mapping of the customs duty going up, there is going to be a huge outlay on account of this particular levy called social welfare surcharge, which is in the nature of customs duty, therefore no credit, therefore cost, therefore cascading effect of taxes, meendum GST. Okay, this cascading effect has come back very clearly, very quickly. Within a span of 6 to 7 months, we have brought in cascading effect again through social welfare surcharge. Notification number 11/18 exempts specified goods from levy of whole of social welfare security, says surcharge. 12/18 at the rate of 3% of the listed goods, that is petrol, HSD, silver and gold. And then 13/18 exemption from levy of this on IGST as well as compensation cess under 3(7). So basically they have tried to ensure that the cascade does not carry to GST also. So the cascade is confined to basic custom duty, otherwise there will be a huge impact and there will be huge outcry if there is a cess, this kind of a surcharge levied on the IGST also. To some extent they have addressed it. 8,000 crores is the budget estimates. Straight away they will get from tomorrow onwards. The next item, road and infrastructure cess. So we have started. Now that you have started with the surcharge and cess at the customs level, what prevents the state to think of this at some point of time? Again, another chapter, another section. Goods specified in the 6th schedule, being the goods imported in India, the rate specified in the schedule. The rate is there in the schedule itself. And they talk about this at petrol and HSD at 8 rupees per litre, in addition to any other duties. Revenue expected is 1,13,000 crores. So you have to read the budget papers with the revenue estimates also. You will understand what is the levy and where is the revenue coming from. This is one funny story. All of you are well familiar with the GST legislation. The GST is quite interesting where it tries to declare that certain transactions are supply of goods and certain transactions are supply of services. It's a legislative declaration that this is supply of goods, this is supply of services. They went to very great lengths to decide and declare that if there is a lease transaction, it is a supply of service. If there is a transfer of right to use an equipment, transfer of right to use a vessel or an aircraft, whatever it is a service. Therefore, on the rentals, you pay IGST on import of services. You take an aircraft on lease, the aircraft has to come to India. When the aircraft comes to India, the customs fellow said, this is goods. Please pay basic custom duty as applicable, plus pay IGST on the goods. Then our fellow said, no, on the rentals I am paying IGST on services. You can't again call it as IGST on goods, etc. What the government should have done is they should have declared, saying that we have very clearly stressed out in the legislation that it is the supply of service. Therefore, there is no question of levy of IGST by treating it as goods. That's what they should have done. Instead, they also got into a panic mode and gave an exemption notification. So they gave a customs exemption notification saying that if you are paying IGST on the rentals, you need not pay the IGST on the goods, which is the aircraft. It took them 1 week time to give, for them to understand the impact. So they gave only on 8th July. 1st July GST has come. 6 days, 7 days, people had paid IGST. Therefore, retrospective exemption. This is only one part of the story. In their enthusiasm, they forgot vessels. Then vessels came subsequently. That retrospective has not come. So fundamentally, you should not try to exempt when you have legislatively declared it to be a service. Why? You are giving credence to the thought process that even though it is a lease of an equipment or a machinery in an aircraft, it will be treated as good. Then your entire schedule 2 goes for a 6, goes for a toss. Anyway, that at least they have thought about it and tried to amend the law. And then also be nice enough to say, in case you had paid IGST, we will give you a refund. This is the famous 2 circular story. I am importing goods from UK. While the goods are in transit, I make a high sea sale. When I make a high sea sale, there was a doubt whether it is a supply in the course of import and therefore IGST can be imposed. My view was it can never be imposed because import gets completed only when section 12 takes over. The government issued a circular saying that, don't worry, high sea sales are not taxed. 2 weeks later, somebody asked them a question. Sir, I import the goods, keep it in the warehouse and then sell the goods. Is it taxable? It is taxable. There is absolutely no difference between a high sea sale or a warehouse inbound sale so long as the transfer of title takes place before the goods cross the customs frontiers of India. Import is complete only when the goods cross the customs frontiers of India. Your power to levy tax under section 12 arises only at that point of time, and under section 5 of the IGST Act you have transferred the power to section 12 of the Customs Act. Therefore, the circular created havoc whereby inbound transfers seemed taxable. Now, what is the object of the government? They wanted revenue. Therefore, they have decided to go to the Customs Tariff Act and then introduce a new section called 380A of the Customs Tariff Act by saying that in case goods are deposited in the warehouse and sold before clearance for home consumption, then the value will be the value under section 38 or transaction value, whichever is high, which means each selling aggregate will be taken into account. Your last possible value would be taken for the purpose of 1 IGST at the time of import. But the primary issue is, do you still have the power to do all these things? I'm raising a very legal point. Under section 5 of the IGST Act, you have power to levy IGST on interstate supply. The proviso says, when goods are imported into the country, you shall levy IGST under section 12 of the IGST Act. Duty shall be subject to duty under section 12 of the Customs Act. Which means what? The entire power to levy has moved from IGST Act to Customs Act. You go to the Customs Act, section 3 heading is duty equivalent to excise duty and sales tax. Under the Customs Tariff Act, you can levy only customs duty. That too equivalent to some other levy. So the language of section 3.7 must have been additional duty equivalent to the IGST leviable under the IGST Act. Then 3.7 would have survived. But the language in 3.7 is levy of IGST. You cannot levy IGST under the Customs Tariff Act. Therefore, the primary power to levy on imported goods itself is questionable. Whereas the plenary power, where they talk about the secondary transaction, where the inbound transfer or high sea sale transfer is what they're trying to address through this by assuming that they have the primary power to tax imports. So which means they are still moving around a legislative lacuna whereby 3.7 is not well drafted, and they are assuming that 3.7 is drafted and going for 3.80 and 3.9 onwards. This will be tested in courts again. Now coming to the basic custom duty, this is the first time in the budget where number of changes in custom duty rates have happened. Normally you will have this custom duty, they will increase the duty on umbrella, reduce the duty on walking stick, you know, most of the items, these are all regularly mapped. 1 year they will do umbrella, next year they'll do walking stick, next year onwards they'll go back to walking stick and then go back to umbrella. These are the standard amendments in customs. This time, drastic changes in the rates of duty, and that too on the higher side, which means we are taking a very big plunge. We have been careful not to breach the outer limit of WTO, but we have reversed the trend of the last 10 years of reduction of customs duty. The last 10 years, if you see, there is no increase in customs duty, only coming down. For the first time, we are reversing the trend and touching the top level of customs duty. Obviously, the answer would be to say, this is the best way to encourage Make in India. So the logic of that would be that I am going to encourage Make in India, and that will get justified because every country now seems to be, you know, having ring fencing their own country. If you listen to Mr. Donald Trump yesterday in the Union address, day before yesterday in the Union address, he talks about how America comes first and what policies suit America first. So every country is now trying to do ring fencing. So if you look at this item, all the bold items are increased, right from crude edible vegetable oil, refined edible vegetable oil, food preparations, perfumes, parts of mobile phones, truck and bus rail trails, LCD, LED, kites. So there is no bias towards Gujarat. Kites are also subject to higher rate of duty. Woven fabrics of silk, footwear, nobody is left. Parts of footwear, bricks, refractory bricks. Solar tempered glass for manufacture is the only one that qualifies for a lower rate exemption. Diamonds, cut polished stones, non-industrial diamonds, imitation jewelry, spark ignition engines for certain motor vehicles, compression engines for certain motor vehicles. Mobile phones, charger, cell phone battery, smart watches, LCD, LED, OLED panels, CKD motor vehicles under certain chapter, completely built unit like all this Jaguar and other cars that come. Specific medical devices, sunglasses, watches and clocks, straightway 20%. So you have massive rate of tax changes as far as customs is concerned, which in a way they will address it by saying that this is meant to ensure that Indian manufacture is protected to some extent. And so long as you are within your WTO norms, nobody can ask a question as to saying that you have breached a tariff barrier. Now comes the amendments which will be tested till Supreme Court. Section 1(2) amendment now to make the Customs Act applicable to any offence or contravention thereunder committed outside India by any person. So we now decide to make the Customs Act applicable to the whole world. And we can take action for any offence or contravention thereunder committed outside India by any person. We have the Supreme Court larger bench decision in the case of GVK in income tax, where they talk about extraterritorial jurisdiction and how tax laws can be applied or not applied outside India, whether you can extend your arm. You must establish nexus. If you can establish nexus, you can levy, or you can subject the person to taxation, or subject the person to some sort of compliance. So now this is a new trend. Definition of assessment completely expanded. CBC now renamed as Central Board of Indirect Tax and Customs. And then one more step. Indian customs water means water extending up to the limit of exclusive economic zone. So we take the coastline, 12 nautical miles is the territorial waters. Next 12 nautical miles is the Indian customs waters, which means up to 24 nautical miles, customs officers can stop a vessel and search or ask questions. Now you are going up to 200 nautical miles. So up to 200 nautical miles exclusive economic zone, customs have got absolute jurisdiction by virtue of this amendment to section 228. There's an amendment in 30AA. Frankly, I don't know which case law they're nullifying. I didn't have time to locate the case law, but I'm sure there must be some case law to nullify because it's an absurd amendment. Notification published in official gazette and the expression notified with its concrete meaning and configuration shall be considered accordingly. So obviously some view must have come somewhere as to what is notified, what is notification. Scope of assessment completely expanded. See, interestingly, if you take customs, goods come into the country. No item is taken up physically for verification unless there are circumstances which warrant verification. So there is something called as RMS, a risk-based risk management system. The system throws out potential items for verification based on pattern, document description, etc. Otherwise, goods will simply go through. This RMS has been there for the last so many years. Suddenly they discovered, how is RMS there? Customs Act does not talk about it. Under what power is RMS implemented? they got panicky and they amended the law, whereby now they are giving a legal backing through risk-based selection. So now this opens a new Pandora's box. Now that you have brought this risk-based selection through all legal authority, which means what happens to all the assessments completed in the past based on risk-based? You have another weapon to argue saying that you don't have the power at all. Reassessment is widened to make it general, any reason. Provisional assessment now goes up to exports, time limits for provisional assessment, etc. And then this new concept, pre-consultation, pre-notice consultation before show cause notice. We want to issue show cause notice, come, discuss, and then we'll decide whether to issue or not. Show cause notice itself is terrible. And then you want to pre-consult. See, this is all these Western principles, you know, where they apply the best practices, so-called best practice, saying that you want to settle the case, you settle the case, close the matter, pay the taxes, pay the penalty, etc. But it works otherwise. It works in a very, very negative way if you're bringing this kind of provisions at this point of time. Show cause notice is a legal process. You adjudicate and fight it. And then another category, supplementary show cause notice under such circumstances, such manner as we prescribed. Prescribed is a dangerous word because board will come and give you various guidelines. See, our bread and butter has been on the premise that if you draft a Sumar show cause notice, you suffer. So if you don't invoke a particular provision, I will take advantage. If you have not identified the manner in which the offence has been committed by the SSE, you will fight that based on the show cause notice. Now, it's like saying that we'll issue a show cause notice, whatever is missed out subsequently added through supplementary show cause notice, which is very, very dangerous trend of the entire adjudication process. I'm sure this will be tested in courts. Boards are going to fix monetary limits, which is already there in service, used to be there in service tax, now coming under customs. New exemptions have come, which are very minor, we can skip that. Complete change in advance rulings. Now what they've decided is that the Commissioner of Customs or the Principal Commissioner of Customs will be the advance ruling authority. So if you have an issue as to classification, rate of tax, applicability, notification, whatever, you don't have to go to AAR. You file an application before the Commissioner who is notified for this purpose, and he gives a ruling. The philosophy of advance rulings always has been is that that ruling is binding on the applicant and the department. That's how AAR has worked historically. Now what this says is, get a ruling from that fellow. If you don't like it, you can go on appeal. And to whom do you go on appeal to? To the Income Tax Advance Ruling Authority. So there is an AAR in Income Tax who was given a wider power last year. All customs, everything was brought into that AAR. So the AAR functioning authority as far as income tax is concerned will be the appellate authority against the Commissioner's ruling. Fair enough. Assessee is not happy with the ruling, therefore he is going on appeal. Department can also appeal against the ruling. So if the Commissioner gives a ruling saying that this is exempt, the another Commissioner can decide that no, go on appeal to AAR. So we are now creating a fresh litigation process. So it is no longer you create the advance ruling, then the order, then the appellate mechanism. Full-fledged appellate mechanism has been created, and after this authority, you can always quote the Columbia Sportswear judgment and file an Article 220 writ against the AAR order also. Supreme Court has said you can file against the AAR. Therefore, this advance ruling purpose itself is lost, because the whole idea of advance ruling is that there is a quick answer to the whole situation, whereas you're back to full-fledged litigation. Lot of changes in procedure. I'm not going into those details, but every provision relating to procedure has been amended, whether it is 30 or 41 or 45, 46, everywhere there's an amendment. And now they're talking about electronic cash ledger for like our GST, they're creating a cash ledger and credit ledger. Completely new chapter for audit. So just like, like the earlier days of service tax audits, we're now going to have a customs audit, where after the goods are cleared and assessed, an audit authority can ask the questions whether it was correctly assessed or not. So this is a very big difference, because in customs, you clear the goods, you consume it, it goes off somewhere. Whereas then you go for assessment as far as the issue is concerned. I have not yet understood what they mean by 109A, but it probably indicates that the proper officer will undertake controlled delivery of any consignment to watch who is the intended beneficiary of the consignment. So that is what they're talking about. Again, they must have followed from somewhere. Confiscation, again they have a power to issue supplementary SCN. Best amendment, Commissioner Appeals is now getting back the power to remand. If you remember the old history, earlier they didn't have the power, they had the power to remand, and they felt that the remand means the appellate authorities are quickly remanding the matter and therefore no decisions are being taken, and therefore they removed the power to remand and confirm to confirm, modify and annul. You know, those are the kind of powers which they had. Set aside was not there. Now they're restoring it back subject to 2 or 3 criteria. This is an agreement which India signed with reference to trade facilitation, whereby there are a number of procedures which you have to follow for customs purposes. Globally, you have agreed this, and therefore 143A is now going to implement that. Just like how income tax brought this concept of exchange of information, they are borrowing from income tax, 151B for exchange information with other countries on reciprocal arrangements. So the moment you load something there, that fellow will share the information here saying matter has been loaded there, please take care and impose whatever duty you want to impose. I was surprised, nothing on service tax, something is there. Because there is no way they could amend service tax, because service tax is repealed completely. So they are still doing this retrospective game. Life Insurance Service Provider Naval Group Insurance Fund to personnel of Coast Guard for the period 10/9/2004 to 36/2017 retrospectively exempted. Whoever has paid can ask for refund. Then this GSTN, this is a very unfair exemption because it says services provided by GSTN. Many of you are chartered accountants who practice GSTN looking at the computer every day. You get up in the morning and then pray to all your preferred deities that today the portal will work. And then you switch it on and then you discover that God has not been very kind to you. Today also portal did not work. So that service provided by GSTN, they felt that it should be exempted, and therefore they given an exemption from 28/3/2013 to 36/2000 retrospectively. From petroleum perspective, they were also given a retrospective exemption. These numbers are amazing. CGST collection 6,03,000 crores. This is what is the central government's projection of CGST collection. This is their share, specifically central government collections. IGST is 50,000 crores. But then they also put a caveat saying that IGST is subject to apportionment fund settlement. So that is very clear because it will go through the set-off route. Cess, they are collecting 90,000 crores. So the 6,00,000 crores, read with the petroleum collection of 2 lakh something, read with the customs collection, is the actual indirect tax revenue of the central government, which will be something like 9,00,000, 9,50,000 crores. Which is a huge money, which can also mean to some extent inflationary. Because if you're talking about these things, they're all indirect tax revenues. So to all extent, whenever there's an indirect tax jump, it will always have an inflationary impact. So these are some of the aspects of this budget 2018 insofar as indirect tax is concerned. Significant changes in customs compared to what was there in the past. And I thank you once again for a very patient hearing.
We'll take some questions, both from the experts.
See, let's look at the controversy. I import certain goods, file a bill of entry for warehousing, keep the goods in the warehouse. When I deposit the goods in the warehouse, I am not required to pay any customs duty. Subsequently, I file a bill of entry for removing the goods from the warehouse called as ex-bond bill of entry. At that time, I am required to pay BCD. Therefore, import is complete only at the point of time when the goods come out of the customs control, whether it's an husband 17 or 18. While the goods are in the warehouse, I find somebody to buy these goods and I transfer title. When I transfer title, a sale takes place. But the sale is also part and parcel of the import transaction. But the language of section 7.2 of the IGST Act is tricky. The language of the section 7.2 says that supply in the course of import into the country, even though it's not a charging section. Therefore, a view emerged that when I bring the goods into the warehouse, there is no impact. When I transfer the title to the goods while the goods are in the warehouse, I must pay IGST and collect from the customer. The customer is now the owner. When he clears the goods, he has to pay IGST as an importer, which means if the rate of IGST was 28%, you had a 56% impact on this transaction, thanks to that circular, which was absurd. Therefore, they realized that before further chaos happened, they felt that let us tax the total value at the hands of the importer at the same rate. That is fair enough. That arrests the problem, which is what they've done. Nautical miles. I'm reminded of my early teaching days. Years ago, I used to explain this concept to my students. Some of them I see as faces here charred up, and they should recollect my example. I'm sure he will answer the example himself.
Don't invite him.
There was always this doubt as to what is this territorial waters and what is this nautical miles and what is this customs waters. I always used to give examples with films, because I am passionate about films. So if you remember one of this crazy James Bond movies, there is this super villain who has got this control of a CD. In fact, I still remember the guy's name. Gupta is the IT guy who developed this CD in that film. Tomorrow Never Dies. So this CD is such that he can alter the movement of satellites. Therefore, a vessel appeared to be in the international waters, but was within the territorial waters of China. Because of the satellite image that he got, he thought he was in international waters, but he was actually in the Chinese waters. And if you are in the territorial waters and you are not answering, it is an act of war. You can be shot at. That's the international principles, maritime principles. Therefore, the Chinese authorities shot this vessel. Whole thing was managed by this fellow. Therefore, he was the first to report next day. That's the story behind the film. So what it means is, up to territorial waters, it is the country's sovereignty. Anybody entering the territorial waters is questionable. Beyond the 12 nautical miles to the next 12 nautical miles is what is called as Indian customs waters, where you don't have sovereignty, but you can check and stop the vessels or stop the boats for questioning whether any contraband is there or smuggling is there. For that, the best example is the film Nayagan, where the official smugglers refused to smuggle this transaction, and Velubai offered to smuggle, and therefore he, along with his friend, goes in a boat, goes up to a distance, and then forget the song and sequence that goes along with that. At a point of time, the customs officers board that boat and check it out. Now that is the Indian customs waters where they have jurisdiction. Indian customs waters, if you cross 24 nautical miles, that's 12 plus 12, you cannot have any customs officer questioning anything. Exclusive economic zone is up to 200 nautical miles, where anything can happen. You can mine for some valuable mineral, or you can hunt for stolen treasure, or you can shoot blue whales. You can do all those blue whales, real blue whale, not that game. So you can do all those things within the 200 nautical miles. It's called exclusive economic zone. Now, first time, no country has this provision. India has got this provision saying that we can go up to 200 nautical miles. Probably they have their mind in the oil rigs and other things which are happening outside. We'll have to see why they need this power. Maybe something might have happened for them to think about this, but this is a very, very interesting provision that has happened. Imports.
Sorry. While Vaidiswaran was explaining that 200 nautical miles, I remember a real case which was reported in the newspapers. It is connected with this 200 nautical miles, and therefore I move out for my safe zone and talk something about customs also. A smuggler was in the process of smuggling gold from a neighboring country to India, and he had carefully packed the gold which he wanted to smuggle in the heel of his right shoe and brought it on board a ship, and he was traveling to India. The customs people somehow came to know about it, and they were aware of the expertise of this person, that the moment he comes and lands into the port of in any port in India, the gold may change hands and it will be difficult for them to catch. Therefore, when the ship was on high seas itself, the customs people went to the high seas and got into the ship, and that person was sleeping in his cabin, woke him up, removed his right shoes and checked up correctly and found the jewelry. The moment the custom people caught him, he fainted. He fainted, and the next day, after a few days, the case came up before the court, and the advocate who argued in the Madras High Court, he said that, where did you catch this man? We caught him in the high seas. How do you know that he had no intention to declare the gold as soon as he come to the port? It is presumptuous on a part to come into that conclusion and go to the high seas and arrest that person. It is beyond their powers. And there he himself would have declared the gold and paid the custom duty. And the man escaped by paying only the custom duty, but saving himself from penalty and consequence. Now, from what I hear, they could go up to 200 nautical miles. Am I right? 200 nautical, and possibly everything has got a history. People would have done it, and if the income tax law as well as the customs law, which has been a small legislation, now has bulged into such a big legislation, it's partly because of the methods resorted by people to reduce tax. Partly, I'm not saying 100%. So these type of things will come. And one more thing from the income tax side, which I was explaining, which I did not touch upon, on the income distribution by mutual funds, there's an income distribution tax of 10% which has been introduced. So on the equity funds, if the mutual funds are going to distribute income, there's another 10% tax which has been introduced by amending 115R of the Income Tax Act. We are also very familiar with the concept of conversion of an asset into stock in trade, and the series of judgments and subsequent amendments brought about in the income tax law. Now we are going back a situation where we are going to convert our inventory into a capital asset. Now, if we convert our inventory into a capital asset, then what are the various capital gains implications have also been incorporated in this budget in the Finance Bill 2018. So earlier it was conversion of an asset into stock in trade. Now it's a reverse technology, conversion of an inventory into a capital asset. Then what will be the consequences they have narrated in this Finance Bill. Thank you. Section 9. In the context of?
BEPS initiative.
Huh?
BEPS initiative. The escalation to section 9(1) then 9(1) clause 1 escalation 2.
If there any other question, you can continue. I will tell you. The 12 months.
Yes, or that is
12 months.
intact.
That they have not changed.
It will come in 2-3 weeks time. There were a lot of requirements based on the parliamentary committee report, where they had to change a number of sections, specifically for example returns. They have to amend the act for it to make it a one return. It's going to come as a one return ultimately. compensation limit to be increased to 2 crores. For that, they have to go back to the Act. Making export even more simpler, they have to amend Section 16 of the IGST Act. So there are a lot of section-related changes to be done. From what I understand is that it is pending in the Ministry of Law, and therefore you might either see introduction in the amendment stage or a Taxation Laws Amendment Act another 2-3 weeks later. GST law, it won't go away almost Sikrama. No, petrol won't be included. Okay. That is why they are living this and all on this petrol. They are not going to take anything out of petrol. Okay. The point is, they probably lost steam in amending GST because every day they were amending before the budget. It's like we always call this pre-budget memorandum. Before the budget, at least about 5-6 mini budgets involving GST. On 20th January itself, there are so many changes in the notification, substantial changes in notification, whether it affects the education sector or the construction sector, or talking about development rights. Number of changes have already been made. Therefore, legislative changes will take some time. 2-3 weeks, it will come again.
The two explanations under Section 9, which have been added, frankly, it is because the type of business is just being carried on. We are not able to find out where from the business is being carried on, what is the location, what is the site is, and charge that income to tax. Therefore, we already have equalization levy, which is outside our income tax net, There is, in addition to this, the term business connection. What is business connection has been defined in Section 9 earlier also. But now they are trying to expand that if the contract is, you give the particulars of the non-resident who is doing the contract, and if that type of city information is given, it will tantamount to business connection, and if it amounts to business connection, that part of the income which is attributable to the business connection will be deemed to accrue as interest chargeable to tax. To my mind, this will be a fertile ground for future litigation. And not only that, if you see the next explanation, 2A, significant economic presence. I am one against using adjectives in any law. If you use adjective, it's always a problem. You have to be very precise. And these types of words is going to create havoc for us. And the way they understand significant, significant is a relative concept. What is significant to you may not be significant to me. What is breakfast to you may be lunch to me. So it could be either way. If that is the case, using these type of expressions is going to create a lot of problems. I do not know what in context of GST is said.
I understood the context. See, there are 2 or 3 subtle concepts. One, if there is an import of service, and the import of service is done by a business entity, you are going to have the reverse charge impact of GST. If you are going to have a service which is flowing from outside India, which fits into your OIDAR, and the recipient is a non-business category as they defined in that legislation, then that foreign fellow is supposed to pay the GST on this transaction and get a registration for this purpose. These are the 2 concepts which are there. Now, Section 9 amendment seeks to get into BEPS territory, and the whole logic of BEPS is that the person does not have a seeming presence in India or for the matter any other country, but seems to derive significant income from operations arising here, and therefore is there some way we can create a connection to that fellow and make him taxable. That's the whole idea of BEPS. For example, if you take today the New Zealand would lose revenue on account of signals being beamed from Australia in terms of television networks or films downloaded into New Zealand from Australia. So New Zealand tried a reverse charge, something like that. So you have this scenario where something is coming from outside India completely. That fellow does not have a presence here. Can you create a business connection either because on market or based on what Sir said as significant economic presence? Significant economic presence can be very widely interpreted, and therefore if you create a presence and then you categorize as a business connection, then you will want the income attributable to that being taxed. And then you will also want that fellow to obtain a PAN and offer the income here. Once he obtains a PAN, and has this business connection, you will get into one more quandary as to whether you as a recipient of the service should treat this as an import of service and pay reverse charge, or he should be the supplier because he has a registration here and should charge you GST. So whether reverse charge or forward charge will be the next level of debate thanks to this. This is not just one more example. If you take the Formula 1 judgment of the Supreme Court in the case of permanent establishment, they went on to the extent of saying that the testing track by itself constitutes a permanent establishment because there are significant operations there. Therefore, if a PE is created for income tax, can it become an FE for the purpose of GST? If a PE is recognized as an FE for the purpose of GST, then that FE, that is fixed establishment, requires registration. If registration is required for that person, should he not charge you GST and reverse charge is not applicable? So we have opened all kinds of issues with multiple amendments in the direct tax. That is separate. That's where a comedy tani track. In the cinema, a comedy track. Equalization levy itself is a fit levy for challenge on the ground that the taxing provision talks about a service. If it's a service, you already had a finance act which levied service tax on that services, and that was also applicable under reverse charge mechanism. So to levy through another finance act, equalization levy, is a subject matter of challenge, but unfortunately nobody has challenged. Probably this they will take.
Basic limit of 1 lakh or deducting 1 lakh, or once it passes 1 lakh, full amount on for first rupee and the pay panama India.
Threshold marla
No threshold. Yeah. Once it crosses 1 lakh, entire thing you have to pay. Per year on the equity shares and the equity oriented funds. But if you have a building a long-term capital asset, if you have something more, that is all right. On the equity funds and the equity shares should not exceed 1 lakh. Net of loss. Net only.
Thank you, sirs, for all the clarifications also. I now request our Central Council member CA Shri Priya Kumar to hand over a small memento to our speaker C.R. Bhupati. I now request CA Hemavati to hand over a small memento to Advocate Vaitishwaran, sir. I request Falna Kumar, sir, to propose the formal vote of thanks.
So it's a pleasant job to propose the vote of thanks. As usual, at short notice, preparing for the subject, both direct tax and indirect taxes, the speakers have taken it as a challenge and then have put it in a lucid way to make all of us understand. Definitely, it's a very good effort, and especially serving the cause of the profession. Both the doyens have been doing it for decades. So, on behalf of the SIRC of ICAI, on behalf of all of you, I propose this hearty vote of thanks, the gratitude expression to the direct tax speaker, Sri R. Bhupati. As he has been mentioning, as a teacher, he was also my teacher 39 years back. So as a teacher he has been serving, now as a faculty, is a speaker for this budget also he has accepted and done this. So we thank you, sir, for accepting and giving us this wonderful insight. In fact, we are feeling sorry the government has not brought more amendments for you to give. more homework. So similarly, in the indirect tax front, we were all expecting in the GST some amendments. So not a single amendment mentioning in the budget, but anyhow, as you have rightly said, the first word of the finance minister that in the past 3 years, you please look, we have brought down the fiscal deficit from 4.7 to the current year 3.5, and next year we are going to bring the fiscal deficit to 3.2. So that is the real economic consolidation the government has done. That is a great job. So the inflation effect by collecting the taxes, maybe the fiscal deficit consolidation will offset, and people at large may get the benefit when the rupee consolidates. The intention of the government when they consolidate the economy, the purpose of the government is serving in that way. So for explaining those numbers, our indirect tax speaker has brought those numbers also, though there are the huge numbers for collection. So they are going to spend the money again for the welfare measures, and especially they touched that 5 lakhs rupees per family. So 10 crores families. So social security, which we have been aspiring that in America they collect the tax, means they are giving the social security. So the finance minister also slowly introduced and said this may be the beginning, but we may expand this also, the finance minister said. So the social security, by collecting the taxes, again giving back to the society by social security. So all those good points our indirect tax expert has explained us also. So we thank you, sir. Once again, we assure you that we will have many more listenings from you. So this is beginning on behalf of the SIRC. And a big thanks to all of you also who have come down patiently and then listening for this much time, and then giving us the SIRC to do many more good things. So this past 2 years period, to say cumulatively, we are having the good response from members for all our good programs. So this is a regular feature. Anyhow, you have all taken the trouble of coming over here. For all of you also, on behalf of the SIRC, to encourage the SIRC programs and participate in large numbers. Thank you, one and all. Please.
Thank you, Vijay.
CP attendance sheets are circulated. Those who have not signed can sign the sheets. I request all to stand for a national anthem before we disperse.